Okay, let's get started. So yeah, I'll explain everything. A lot of people raised a lot of questions during the break, so I will explain all the questions that people have been asked during the break once again. So first, people asked me to explain the practice question number 34 once again. So let me just go through it once again. This is basically the question regarding the maintenance margins. So what is the question about? It says that we have a company. This company enters into a short futures contract to sell 500 bushels of wheat, 小麦500桶 bushels 的小麦 for 750 cents 750分7.5块。The initial margin was $3,000. The maintenance margin was $2,000. 所以现在它如果降低1000块，我们就要 we will receive a margin call when there's a decrease in $1,000. So let's think about what is the situation that we will experience a $1,000 decrease. 我们想想看，怎么样的价格变动会带来1000块的损失 ？We are in the short position, so an increase in the price would lead to a loss to our short position. So how much money should it increase for us to experience a $1,000 loss? The answer is 20 cents. Why was that the case? 20 cents per bushel, because we are to sell 5,000 bushels. And then when there's an increase of wheat from 750 cents per bushel to 770 cents per bushel, then there will be $20 cents loss per bushel. And because we are to sell 5,000 bushels, we will experience 0.2 multiplied by 5,000 equals to $1,000 loss. So if it increased from 750 cents to 770 cents, we will receive a margin call. Now, when will we be able to withdraw $1,500 from our account? Basically, it asks, under what circumstances will our margin account increase or obtain a gain of $1,500? The answer is, of course, now we are looking at the opposite price. It decreased from, so previously when it increased for 20 cents per bushel, we will have a $1,000 loss. Now, of course, if you do a math, you know that when there's a decrease of 30 cents, then we will be able to obtain a 1,500 gain. That's the reason why, because when there's a gain of 30 cents per bushel, that's $0.3 per bushel, multiplied by 5,000 equals to 1,500 increase. So yeah, that's question number 34. Now let me explain about this. Let me explain about this once again. So some people still ask me, why would people close out their position, even if they are to deliver, even if they are to buy or sell certain products? Later on, we will see. Yeah, I think this could be better in a few slides afterwards. In reality, this is the most obvious type of hedge we could consider, but in reality, there may be a situation where if you are planning to buy or sell certain products, you may not be able to find exactly the same a futures market for that exact same product. So in reality, when people are doing hedge, long hedge or short hedge, they may be using some products that is very, very similar to the products that you're interested in, but still has been very vivid futures markets. That is the case. So they damn, where's we will have an example where people are trying to do a hedge when they are an airline company. Yeah, this one. I think it's cross hedging. Yeah, cross hedging. So later on, we will discuss a situation where people want to use some products to conduct the hedge, but like this one, there's an airline they are planning to buy 2 million gallons of jet fuels, 机油, 飞机机油. But in reality, there's no futures market for such jet fuels. So they will enter a heating oil futures market where heating oil's futures is much more available. But then you know that they are actually using a different products to conduct the hedge. So even if they long this kind of products, still at the end of the day, that's not the things that they are interested in. But still, the argument why this would work is because the two spot products may have very high correlation. So along the futures market, along the fluctuation of the spot prices, they may still experience something very similar to as if they are the products that they are interested in. Does that make sense? Okay, let me explain it once again in Mandarin. 就我们刚刚看的这些例子，都是非常理想化的例子，就是我要卖这个石油，然后我就进入一个 short position in the 石油 market。但实际上，我们后面会学到很多情况是实际上并没有那么理想的情况。你想要买卖某一种商品，但这种商品的期货市场可能不存在，所以你就 instead 你找了非常相似的商品，然后这个商品可能有一个非常活络的期货市场。那找非常相似的商品的逻辑，是因为这两种商品，它这个有期货市场的商品跟你想要买卖的商品，它们之间的现货可能有很高的 correlation， 所以你在做这样的 hedge 的同时，你其实是就已经它接下来会 experience 的所有的那些 margin 的变化，都跟你像你用真的你想要买的这个商品。假设它真的有一个期货市场，这样做的同时，它是相似的，但是终究它是一个不一样的商品，所以你不可能真的期待你最后你要做 delivery， 所以这是另外一个原因，为什么我们一定会 close 在那个交割日之前，因为我们并不希望我们做这个动作只是为了要the main purpose was to hedge, is not to deliver such products. So again, back to our examples. So we have the short example and the long example. Again, we are constructing them to provide a hedging strategy. It's not the purpose. And you can see that there are a lot of reasons why people do not deliver. Again, delivery is very costly. It could be very different. Like, for example, if you are to, say, conduct a sale on the spot market of a crude oil, there may be a very vivid crude oil spot markets everywhere in the world. But in reality, if you enter this hedge and try to assume that you are to deliver, it could be the case that you may be delivering to places exactly at the opposite place on the planet. So it could be very costly comparing to selling it on the spot market. So that's again another reason why people would like to close their positions, to just avoid all kind of uncertainty related to the delivery process. Okay, so now let's get back to the long hedge situation. Again, we are to buy Cooper's tone in 4 months. So then the stock price on January was 340 cents per pound. And then the futures market on May 15th, the futures market on January, which would mature on May 15th, is 320 cents per pound. So then now we enter 4 long contracts. Again, we follow the exact same logic. We close our positions right before the maturity date. We know that right before the maturity date, the futures price would be very close to the spot price. We enter a long position to buy the Cooper for $3.2 per pound, but then we exit the position when the futures market was the futures price was 3.25. We actually obtained some gain by our position on the futures market. But at the end of the day, we still need to buy 100,000 pounds of push, 100,000 pounds of coupon. So then we will buy on the stock market. At the end, it's similarly to we lock to a price to buy it on the futures markets. Again, people may think that we are doing things a bit redundant, but reality is that closing out the futures position and then doing the trade on the spot market is actually less costly and more straightforward comparing to letting the delivery process to go through. Okay. There are still some arguments in favor of hedging, and there are also arguments against hedging. Like people think that we are doing hedging to avoid risk. And why are we trying to avoid risk? It could be because an argument could be that this is not related to our business, and we are not expert in anticipating this the price, the spot price, the fluctuation of the price on the market. So people would actually be found of having the company to focus on their main business rather than anticipating all the future prices. Future prices, not futures price, future spot prices. On the other hand, there is also another argument. There are also a few arguments against hedging. Some people would say that the company doesn't need to do the hedge themselves because the stockholders, the shareholders, could actually conduct the hedging by diversifying their portfolios at first place. But at the end of the day, there are still so shareholders could hedge to themselves by diversifying. But at the end of the day, if you consider the company as a unity itself, you would say that it's still having a hedge to guarantee its own business, to guarantee its own profits to be steady is also still favorable. On the other hand, there's a very interesting example from the textbook that says that there may be hedging may actually lead to more fluctuations when your competitors do not do so. Interestingly, in the textbook, there's an example where they were talking about gold jewelry manufacturers. So these manufacturers, they actually buy gold, raw gold, to construct manufacturing to make them into jewelries and to sell on the market. But even when we see a fluctuation in gold price, because they can perfectly transit this cost to the low-end consumers, the people, the potential buyers of the jewelries, because when gold increases, they could just raise their price of their products. When the gold price goes down, they could just sell it for a lower price. If everyone in this gold jewelry industry is doing so, but then you suddenly be you are the only one who try to hedge the gold price. Then in reality, because the gold jewelry price also fluctuates with the gold price, you're going to see that even when you have a very fixed cost of your raw gold materials, you're going to have more uncertainty, more fluctuations in your outputs, in your sales. That is because you are going to see more fluctuations in the selling end of the gold jewelries. But that's also a very interesting argument you can see on the textbook. Lastly, this is something funny to talk about. Like when you think about you as a CFO, you're trying to hedge all the financial fluctuations, and then your CEO suddenly comes out and asks you, why are we incurring some kind of loss when you try to do a hedge? It's sometimes very hard for people to explain why there may be a loss when there's a hedge, because people are usually found of they are happy to see a gain when they are conducting a hedge, but they forgot they were hedging. But then this logic also applies to the situation when you incur a loss, that people forgot they were just basically trying to hedge at first place. So again, yeah, hedging may be troublesome when it comes to facing your boss, facing the people who you should be in charge of. So yeah, these are just interesting discussions about the idea about hedging. So now let's get back to our business. So basis risk. Basis risk is the main focus of this chapter. It seems that we might not be able to finish this chapter, but yeah, I'll try to see how far we can get through. What is basis risk? Basis risk is, I have just mentioned one type of basis risk at the beginning of this class. It could be the case when you are trying to hedge, but then you cannot find the perfect exact same underlyings for you to conduct the hedge using the future market. The product you use may not be different, may be different, or the time to maturity may not perfectly allied with your own interest. These kind of small friction and small frictions are actually what we call a basis risk. How do we measure basis risk? The way we measure basis risk is actually very straightforward. We just calculate it as the difference between the spot price and the futures price at the same time period. That is the idea about basis risk. Why could it actually measure basis risk? Let me show you why with some math notations. Don't worry, they are not sophisticated at all. They are not hard at all. They are very straightforward. Let's consider a two-period model. Even though I say model, there's nothing really, there's no parameter that's really fluctuating within. It's just easier to express in math notations. Assume we have two time periods, T1 and T2. Both T1 and T2 are before maturity. The maturity date is after T2. Say, you can take a look at like this table. T1 is the time when we are trying to establish a hedge. T2 is the closest time that you can close out the position before it really matures. So we have T1 and T2, time 1 and time 2. So what do we do over here? Because we have two time periods and we have both the spot and also the futures market. We have the futures price at time 1. We have the futures price F2 at time 2. We have the spot price at S1, spot price at time 2, which is S2. Now, what is B1 and B2? Like I said, we measure basis risk by calculating the difference between the spot price and the futures price. Usually we calculate it as spot price minus the futures price. So it turns out that B1, the basis at time 1, the basis at the time when the hedge is set up, is calculated as the spot minus the future, S1 minus F1, and B2, the basis by the time we are to close out our position is calculated. So why are they useful? Because they are useful because you can actually see where we can decompose the gain or loss according to our hedge into the basis. So now assume we are doing exactly the same hedge, the long hedge or the short hedge that we were previously showing you guys, like the perfect hedge, the perfect short hedge. Over here, we begin our hedging by going into a short position at time 1, and at time 2, which is very close to maturity, we close out our position and then we really sell the products at the spot market. If that's the case, what is the gain or loss we are going to experience? Basically, we are going to sell it we are going to obtain F1, but also we enter a long position at F2 at time 2. So this F1 minus F2 is basically our gain or loss from the trade. We are selling it on the spot market. It's also S2. The F1 minus F2 is essentially the 79 minus 75 or 79 minus 5. Thus, the futures price on May minus the futures price before the maturity. And at the end, we are still selling it at spot price. So we are getting S2. That's the spot price. And if you do some very simple calculation, you can see that S2 minus F2, that is actually the basis on time 2. So we can rewrite our gain or loss as F1 plus 2. That's also so that's one way we can see how we can decompose our gain or loss according to our hedge. F1 is the price we set up the trade, we set up the hedge. B2 is the basis at time 2. In previous situations, we mentioned that we are doing something like perfect. So bases are basically 0. That's the reason why we end up with, in our previous example, we end up with a payoff that is essentially the same as the short price we set up on May, $79. That's because the difference between is essentially zero. But in reality, if you just take a look at this plot, you know that we can never do actually 5 2, the base is 2. Okay. So now let's do one example. Assume we are to sell something and we are to enter a short position in the futures market. Our price was $2.5. Assume that we can perfectly anticipate, or if we are assuming what time 2, the spot price goes to $2. By the time we say $2.2, and by time 2, you can see that the difference, the basis has decreased, has shrunk, but then still it's still non-zero. Assume F2 is $1.9. We know that the basis was $0.3 because 2.5 minus 2.2 was 0.3. Basis at time 2 go down to 0. The seller, we're trying to sell at time 2 and we take a short position, then the price that we are really selling at is 2 because we close out our position at time 2 and then we are selling at the spot market. And again, the profit on futures is basically we enter the short position, we're not to sell it at F1, but then at time 2, we close out our position. So then there's a negative 2. Basically, this is what the same, you can just do a one-to-one mirroring to our previous perfectly hedged short hedge examples. Now, the effective price, what does effective price mean? It means that the unit price that you are really receiving, the payoff for each unit of assets that you are selling is basically S2 for the spot price, the log 2, plus the basis. You can calculate it in either ways, but then you'll end up with the same answer. It's just, we're just switching the notations. Everything okay so far? Cool. Now let's consider a different situation, but this is not so different. It's just that now we're thinking about if we are the long side, basically, it's basically the same. Even if we are standing at the position of we are the long side, we want to buy something in the future. I think the interesting part here is that later on we are going to talk about a very cool situation, which is called cross hedging. And I think that's everything we learned so far in this chapter was built up to learn this cross hedging example. We want to hedge something, but then that's something that underlying does not have an existing futures market. So we need to find a product that is very similar to our underlying, which also has a very vibrant futures market. So in that case, we can further decompose our payoff into, but then we have S2 minus S2, let's plug an S2 star and S2 star in between. What is S2 star? Assume that this S2 star is the thing that we try to hedge. This is the thing that we want to hedge. And then you can see that our payoff can further be decomposed into F1 was we can actually calculate it as basis 2, but then this basis 2 is speech further be decomposed into 2 components. The first component is the difference between assets. The second part is the basis from using the same assets, which is that this is the difference. The basis difference can actually come from 2 parts. One part is that we are actually using different. Yeah, actually, there's a typo. Sorry, guys. I think I should switch. The notations should actually switch. Okay, so S2 minus S2 star is we have these are both the things that we are using to construct the catch, and S2 star is the thing that we are interested in. They are the reason why we have this difference over here is because we are using actually 2 different assets. They may have very high correlation. Later on, you can see I'm going to use the examples that people trying to hedge, the airline trying to hedge their jet fuels using heating oils futures. But at the end of the day, they're still different assets. The second part of the basis basically come from the basis that come from different assets. They are still a difference between the futures market and also the underlyings. So that's the case. That is the idea that we are going to talk about very shortly. So now, yeah, we have some basic ideas and concepts about hedging. When we are to try to hedge some kind of we are a jet fuel an airline, we are to buy some jet fuels in a distant future, in a nearer but distant future. We need to hedge for our decision. How do we do our hedging? Basically, we need to find if there's a jet fuel futures market, then it's perfect. But it's not there, or even if it's there, it might be a very illiquid market. So it's more optimal for people to construct a hedge using similar assets with a much more liquid futures markets. What are we? The first choice is what are the assets on the line to construct this futures market? That's the first question we have. And the second question is, what is the delivery month? So we have been kept talking that different assets have different delivery months. One very big principle you need to follow. The principle is that we want to choose an asset with which has a futures market, and also the futures product has a delivery month that is as close as possible. But even again, the time that the end of your hedge. So assume that you want to finish your hedge. Assume that you are buying that jet fuels in August. You need to find an asset, say like heating oils futures, that has an expiration month or date after August, but not so far from August. The reason why we want it to be later than the end of our hedge is because we have more time. It allows us to, with more time, close out that position. If it's earlier, then if there's no way for us to close out the position by the time we finish our hedge. But still, we want it to be as close as possible. Why is it the case? That's because if we can really make it as close as possible to the end of our hedge, there's much fewer basis risk comparing to if we allow it to still fluctuate for 3 or 5 or 6 more months. So this is the principle regarding the choice of the delivery months. Okay. When there's no futures contract on assets being hedged, choose the contract whose futures price is most highly correlated. This is known as cross-hedging. So everything we have been learning so far, you might feel a bit confusing because we seem to do things, it seems like we are doing things a bit redundantly. But then at the end of the day, we're trying to build up a benchmark, a framework that can help us deal with all kinds of different hedging situations. And cross-hedging is one of the biggest reasons that you need this framework to study. So what do we mean by, before then, let's take a look at one more example. So now let's look at a Japanese yen, a foreign currency futures example. Assume we're standing at the time point of March 1st. And then we are a US company, and we expect to receive 50 million Japanese yen at the end of July in 5 months. Yen futures have delivery months of March, June, September, and December. Do you guys still remember? The big goal in choosing the delivery months, the maturity month, is that it should be after our end of our hedging life, but then it should be as close as possible. So our hedging, we're going to get it at the end of July. So we want to choose, if we want to hedge this position, we want to enter a yen's futures that has an end life, that has a delivery month after July, but as close to July as possible. So the answer is we should choose to enter a short position of this September contracts. It happened to be the case that the contract comes with 12.5 million Japanese yen, so we have to short 4 such contracts. Assume that the September futures on March 1st is 1.08 cents. It means that for each Japanese yen, it could be sold for 1.08 US cents. The spot and the spot price was 1.02. But then the September futures on July. So now let's fast forward. Now we are on July, and we see that the spot price was 1.02, and the September futures on July was 1.0250. You can see that by then, even though there's still 2 months existing before its maturity, the two has actually converged to a very close level already. Even though these are hypothetical example questions, but then it still reflects some of the nature of these futures products. So what do we got? We got actually, if we enter this short position and then we close on July, and at the same time we sell it on the spot price, what we are getting is first your gains from the futures market. We enter the market when the futures price was 1.08 cents per yen, and then entering into a long position at the price of 1.025. So then we actually receive a gain of 0.0550 cents per yen. What is the basis? If you want to consider things on the other hand, just think about the basis is actually the spot minus the futures price, which is 1.02 minus 1.025. The basis by then was 0.0050 cents per yen. So what is the effective price? We can actually calculate the effective price in both 2 ways. First, we can add up the gains to the spot price, or alternatively, we basis to the futures price we set up at the beginning. Both of the two will lead us to the exact same answer, 50. That is the effective price we set up. If you want to understand why, you can think about logically, what it means is that we enter this position by committing to sell at 1.08 cents. But by then, when we close out this position and really sell it on the spot, you can see that there is a price difference between the spot price and the September futures. The reason why, if we close out the position, really sell it for on the spot price, we are actually incurring a point from selling it by closing out this position. Alternatively, you can also think it differently, as we are actually selling it for $1.02 on the spot price, but also we experience some gains from the futures market. We opened it by entering a short position at this price. We close it by exiting the position at this price, so we actually obtain some further gains from conducting this hedge. Now this time here, and then we are to sell 50 million Japanese yen for US dollars. Basically, we just multiply the $50 million with the effective price. Japanese yen is sold for 537,000 US dollars and 500 US dollars. Does that make sense? Any questions? If you got confused anywhere in the examples on this slide, in this chapter, you can always compare the calculation with what we were doing the calculation over here, and also compare it to the beginning, the example for the short hedge and also the long hedge at the very beginning. It seems like an obvious and redundant example, but later on, when you compare the more complicated situations to it, you can actually see where all the numbers are pointing to. So now let's talk about cross hedge. This is the more interesting part, and we have 10 more minutes. Let's see where we can get to. So what does cross hedge mean? Cross hedge means that, again, that is the situation when you want to hedge for some products. You want to buy, you want to sell certain products in the distant future, but you do not, but there is no futures market, or there's no liquid futures market for such products. the best way you can do is try to find a futures market where the underlying is very close to the product that you are interested in terms of correlation in their price fluctuations. So what do we do? But the question over here is that, say, if we have a very similar products, do we, and very similar underlying, which has a very liquid futures market, do we just do a 1-to-1 hedging? Like, for example, if we want to hedge our jet fuel example, if we want to hedge it using the heating oil futures market, do we just buy 1 barrel of heating oils futures to hedge for the jet fuels that we plan to buy in the future? The answer is it's not so obvious. We need to think about what that correlation is and what is their mathematical properties, the standard deviations of their price fluctuations. That's how we may be able to set up a perfect or the most optimized hedge. The optimal hedge ratio is the ratio of the size of the position taken in the futures contract to size the exposures. What we mean by exposure is that the two, for example, we'll see the example very shortly. Assume that we have some futures price for certain liquid products, and this product is closely related to the spot price, the products that we are interested in to hedge for. Then we can basically map their change in prices, the futures market of that future product, and also the spot price of the things that we are interested in. Just like running a regression, you can see that the two has a very high correlation. That's the reason why it makes it a very ideal. We study their price changes, say a monthly price change or weekly price change of 1 by 1 at the same time, and then we map it by fitting it with a straight line. Then that's the slope of this straight line is essentially the perfect hedge ratio that we are interested in. If you look at the formula for hedge ratio, the optimal hedge ratio, H star, is calculated as rho multiplied by sigma. Spot price, the change in spot price of the products. Sigma F is the standard deviation of the change in price of the futures price of that hedging assets, hedging future, the futures contracts that we use to hedge, the instrument that we use to hedge. What's rho over here? Rho is the correlation coefficients between the two price fluctuations. Let me motivate you guys with one example. This example is, I think, the best example to use over here. Back to, this is the one that have been kept mentioned. Assume we are an airline company and we expect to purchase 2 million gallons of jet fuels in a month. Big deal, but then jet fuels do not have a very vibrant futures markets. So we decide to hedge using the heating oils. And we look at their price change along the 15 months. And this is the example from the textbook, so you can also check it yourself. And this is what we see when we have an increase in the spot price in the jet fuels, $4.29 per gallon. That the two has a very high correlation in most cases. When the price increase on the right-hand side, the price also increase on the left-hand side. When it's also the case when there's a price decrease, suggesting that the two may have a very good correlation, also suggesting that the heating oil futures may be used to help us establish a hedging strategy for our jet fuel purchase in a near future. So now let me zoom in. You can do it yourself. I think it's a very fun game to do. Actually type everything up myself. This is the same set of data according to the textbook, according to the slides. I basically type up all these price changes for delta S and delta F. And then what do? We actually, the next step is to calculate the standard deviations. The standard deviation for delta F, the change in price of the heating oils future, is actually 0.031. The standard deviation of our underlying assets, the jet fuel, you can also calculate it on Excel. And what is this though? Though is the correlation coefficient. It can be calculated very straightforwardly using Excel as well. You can calculate it, and then we have, at the end, what is the perfect hedging ratio? It is calculated as rho multiplied by sigma S over sigma F. Still, I'm just doing the calculation to show you exactly how we calculate each star over here. If you have taken a course in econometrics, you will probably know that the same is rho multiplied by standard deviation of y variable over standard deviation of x coefficients. As if you're running a regression of variable y on variable x. So let's do it on Stata, which is my favorite statistics software. I basically also type up all the data information on Stata. And if we run a regression, we regress delta S on delta F. And what we actually observe is exactly the same coefficient. It's 0.07776. If you round it, it will get to if we round it to the second decimal, it's basically 0.78. So essentially, this H star is the regression coefficient. If you guys are familiar with CAPM, later on we are going to, at the end of the slides, which we might be introducing you guys next week, you'll see that we are going to construct a hedging strategy for any kind of portfolio you are holding using index futures. And basically, the H star there would be the beta coefficients for your portfolio, because that actually shows what is the sensitivity of your portfolio to the overall market fluctuations, the market risk. So over here, basically, what it shows is that we know that the spot price of jet fuels actually co-move with the futures. And the sensitivity of our spot product is actually 0.78 of the heating oils. Even though they are two different assets, still they have very high correlation and they have a very nice sensitivity. So how do we set up an optimal number of contracts? If we are trying to set up this hedge, look at our example once again. What are we trying to do? We're trying to hedge for 2 million gallons of jet fuels. And what do we see on the CME group? For CME group, again, is the exchange that is trading, that we can very trade for the heating oil futures and all the other futures. So assume that on CME group, the heating oils are 2,000 gallons of heating oils. Then what do? We know that they have but now we are trying to buy 2 million gallons of jet fuels, and we want to set up a hedge for such purchase. So what we can do is we can actually go into a long position of as much as 37 contracts of such heating oil futures. How do we get this 37 number of our optimal ratios, which is the sensitivity of the jet fuel's price towards the changing jet fuel's price towards the changing heating oils futures. We multiply it by the number of the gallons of oil divided by the number of the heating oils. So we do so. It turns out that we need to buy 37 contracts of the heating oils futures to hedge for our purchase for the jet fuels plans. Our plan to buy jet fuels in several months in the future. Yeah, basically that's what we do. I think this is not the best, this is not the most interesting example yet. Later on, when we talk about the equity portfolio, how we hedge for the equity portfolio, you're going to see an even more vibrant example. But yeah, we are going to see that next week. We will very quickly wrap up chapter 3 next week, and then we will move on to chapter 4. Hopefully we can finish chapter 4 next week. And again, if you have not enrolled into the class yet, but you still wish to enroll and you cannot enroll into the course by Friday, send me an email, copy my TAs about your condition according to the syllabus, the instructions to conduct the manual add-ons. So if you satisfy the conditions, and then we'll conduct a random draw to determine whether or not you satisfy and you can be enroll to the class. Okay, so that's pretty much about it for today. Thank you, guys.